Real estate investment presentation, loan refinancing. Get ready because we're raising the stakes with real estate. There are many factors to consider when thinking about a refinancing option. Some of those factors include the length of time you plan on living at the property or owning the property. The current interest rates will obviously be important. And then how long will it take to recoup the closing costs? Closing costs being something you're going to have to pay up front generally. How long will it take for the refinancing to recoup them? You might also do a rate of return type of calculation. As we consider some of these options here, we're going to be referencing Investopedia, a place that you can go to look up investment-related terminology and continue your research from that point forward. Also note, we'll be taking a look at some of these options here, discussing them. We also work practice problems, which are a really good way to better understand these concepts as well. So obviously, when you ask a question of should I refinance or not, in some cases, refinancing will be a wise decision. In others, it may not be the financially correct thing to do. So we have to consider these factors to determine whether or not the decision be wise or not. So reasons to refinance. Why would people want to refinance in general? So the typical rule of thumb is that if you can reduce your current interest rate by 1% or more, it might make sense because of the money you'll save. So generally, if you're in an environment where the interest rates have then gone down and you have a loan, typically the scenario being, or the basic scenario, you got a 30-year fixed type of loan, for example, and that's going to safeguard you against the interest rates basically going up. But if the interest rates go down, now your fixed loan is at a rate that is higher than the current rates. If it goes down by a substantial amount, then the question is, well, if I refinance, I'm going to have to pay the closing costs, but then I can possibly lock in that lower rate. So then the question is, well, how low does the rate have to go in order to make it a worthwhile option to do the refinance? Rule of thumb, they're saying like 1% here. It will obviously depend on your circumstances, how large your loan is, what the interest rates are. But if you see a significant drop, which could be like a 1% drop, then it's something you might want to look into and, of course, consider. So refinancing at a lower interest rate also allows you to build equity in your home more quickly. If the interest rates have dropped low enough, it might be possible to refinance to shorten the loan term without changing the monthly payments by much. So obviously, if you're going to get a better rate of return, that'll typically be beneficial. You get better payments, possibly lower payments, and if you're having lower payments and you have lower rates, maybe you can restructure it to lower the term, meaning paying off the loan sooner, which would be nice because then you could obviously pay off the loan at a shorter time without actually increasing the payment amounts due to the fact that the market rates have gone down. But as you consider those options, you have to weigh them against the costs, and one of those costs are going to be the fact that you're going to have the closing costs. Another cost, of course, is the idea of what your other opportunities, the opportunity cost that you could do with other options. So the reasons to refinance continued. Falling interest rates could be a reason to convert from a fixed to an adjustable rate mortgage or ARM. Now, you don't really want to recommend that all the time because obviously the rates, we don't know what's going to happen in the future. So the adjustable rates, if you're in a period of declining rates, then an ARM will actually be good because then the rates will adjust downward because they'll be tied to an index and you'll have a more favorable rates without having to go through the refinance. The refinance being a problem if you have to do it repeatedly because you're going to have to be paying the closing costs in order to refinance periodically. So in other words, if you've got a 30-year loan, you got a fixed 30-year loan, and the rates are declining, and you keep on refinancing periodically instead of having an ARM, then of course you're paying the closing costs in order to pick up the lower rates, and you're probably having a lag in the time frame before you get advantage of that lower rates because you're waiting to see that the lower rates are in place. Then you got to go through the process of refinancing. If you have the ARM, then it would actually be beneficial in that case because then you would automatically have access possibly to those lower rates. However, of course, you don't know what's going to happen in the future, and you don't know that the interest rates are going to be decreasing. So if you think the interest rates are going to continue to decrease, you could use that strategy, but you'd also want to keep in mind that that's not necessarily what will happen. And if interest rates go up, you got to take that into consideration with your decision-making process as well. So periodic adjustments to an ARM should mean lower rates and smaller monthly payments if you're in an environment of lowering rates. So if you're in an environment where rates are at rock bottom at this point in time, then it's not likely that they're going to go down, much more than that. Then obviously that strategy may not be the best way to go. So in rising mortgage rate environment, this strategy makes less sense. So obviously if the rates are going up, that's where locking in the rate would be good. So locking in the rate, meaning you have a fixed rate, will typically be beneficial in the event that you have rising prices, because now you'll have that you got that fixed rate, although the fixed rate will typically be higher due to the fact that than you would if you got an adjustable rate, at least up front, because you're taking on less risk. More risk is going to be on the lender side of things. Also, of course, the fixed rate will lower the risk, and that's going to be part of the reason people like the fixed rates, especially if you're in there for a long period of time, then because that gives you more stability about the payments and so on. So the periodic ARM adjustments that increase the interest rate on your mortgage may make converting to a fixed rate loan a wise choice. So clearly, if you're in a situation where you have an ARM type of loan and you're considering and you're thinking that in the future you're going to have increases in the rates, then refinancing in order to fix the rate at that point in time, even though it might be a higher rate at least up front, would be wise, because then you're not going to get hit by those increased rates in the future. It also might just be wise to do if you're risk averse and you would like to basically lower the risk at some point when it's plausible to do so, making the refinance and going into the fixed loan for that reason as well. So consider the closing costs. Now, this is going to be the factor that's always, what you have to weigh against. You're going to be basically giving money up front in order to pay for the closing costs to get this thing whole processed and done. And then in essence, you're going to get basically kind of a return on it. You could think of it as a cash flow kind of problem. We put money down up front, and then you have a lower amount of the payments due to the lesser rate that you have, and or you pay the loan off shorter in a shorter period of time. So what's the benefit? What's my return on that cash flow? And then you can kind of compare that cash flow return to what else you could do with the flow, meaning what's my opportunity cost if I put my cash someplace else other than paying for the refinance. So your outlay will need to cover charges for title insurance, attorney's fees, and appraisal, taxes, transfer fees, all those kind of closing costs. These refinancing costs, which can be between usually that 3% to 6% of the loan's principal, are almost as high as the cost of an initial mortgage and can take years to recoup. So note that the process of actually doing the closing might be a little bit easier for the refinance, because you're not doing the whole purchasing thing. It's just a refinance, but the costs can still be quite high just in terms of the closing costs for it. So of course those are significant and need to be factored in. So if you're trying to reduce your monthly payments, beware of no closing costs refinancing from lenders. So lenders may be saying, hey, we got this no closing costs type of option. But note that if they say that there's no closing costs, it's kind of a misnomer, in that they're making their money in some way, shape, or form, right? So either they can add it to the principal, or they can adjust the interest rate. So usually if you have no closing costs and you were to hold the property to the end of the loan period, the lender's probably going to be better off than if you paid the closing costs up front. So then you got that kind of timing issue as to whether you want to take a no closing costs versus closing costs. We've talked about that a little bit in the past. Won't go into it in too much detail here. But although there may be no closing costs, a bank likely will recoup those fees by giving you a higher interest rate. So they're going to basically say no closing costs, but we'll increase the spread and the interest rate, right? So that means that they're still going to make their money back if you hold the loan over the whole time frame, and you can then get into whether or not you hold it for a shorter period or not, and so on. So consider how long you plan to stay in your home. So you'll want to calculate what your monthly savings will be when the refinance is complete. Let's say, for example, that you have a 30-year mortgage loan for $200,000. When you first assumed the loan, your interest rate was fixed at 6.5% and your monthly payment was $1,257. If interest rates fall to 5.5%, so now they've decreased by that 1%, you're saying, rates are lower, I need to go refinance, it's going to save me money. And so you're going to do that. So it goes up. This could reduce your monthly payments to $1,130 or a savings of $127. So if you refinance, you're going to say now I get this lower rate. So that's great. That means my payments went down by $127. Therefore, I'm saving in essence $127 per month. If you take the $127 monthly payments times 12 payments, you got a yearly savings of $1,524 on the payments. However, you had to pay the closing costs in order to save that money from your payments. And so you could do kind of a break-even point type of analysis or a payback period kind of calculation. So you can calculate your total closing cost for the refinancing. So obviously then you want to think about how much it's going to cost to refinance. Let's say it costs you $2,300 to refinance. That means you put that down up front in order to save that a yearly amount. So then you can divide out the closing cost, $2,300 divided by the yearly savings. That means you're going to make back your investment of the $2,500, your investment in the closing costs, the outflow up front, by the yearly savings of $1,524 in about 1.5 years. So if you plan to stay in the home for 2 years or longer, your refinancing from that basis will pay itself back. Now, this calculation doesn't take into consideration time value of money or something. It's just a quick, nice, simple calculation that gives you a good idea, of when it's going to be worthwhile or when that kind of will pay back. You also might want to do a rate of return, which we'll take a look at in a second here. So consider private mortgage insurance, so the PMI. So during periods when home values decline, so if you had a period where the value of the home declined, hopefully not, but if that's the case, then many homes are appraised for much less than they have been appraised in the past. So if you go into a refinancing situation and you have less equity in the home, then the lender is going to be more skeptical to give a loan because now there's less equity in the home, and therefore they don't have as much support if the home value went down. Hopefully the home value went up, and then you have more equity in the home, and the refinancing will not cause a problem in this way. So if this is the case, when you're considering refinancing, the lower valuation of your home may mean that you now lack sufficient equity to satisfy a 20% down payment on the new mortgage. So now they're saying, if the home keeps going down, we don't have the support that if you don't pay back the loan, we take the home back. If the home basically goes underwater, then it's no longer supporting the loan in the same way, right? That's why that's a problem. So to refinance, you will be required to provide a larger cash deposit than you had expected, or you may need to carry PMI, which will ultimately increase your monthly payment. So it could mean that even with a drop in interest rate, your real savings might not amount to much in that instance. So obviously, again, if your home went down in value, then that could be a concern. If your home went up, then hopefully not. So on the other hand, a refinance that will remove your PMI would save you money and might be worth doing for that reason alone. So in other words, if you had to have private mortgage insurance, like say when you purchased the home, to make the lender more comfortable and so on, because they weren't comfortable with the equity situation, possibly because you didn't put 20% down, then you're paying more for the insurance. And if you could refinance, and even if you didn't have that decrease of the 1% rule that they're talking about, which would possibly make it worthwhile to refinance because the rates went down, if you could refinance and just remove the PMI, the private mortgage insurance, that alone could be something that could be worthwhile to do and go through the refinancing process. So if your house has a 20% or more equity, you may not need to pay PMI, that's the private mortgage insurance, unless you have an FHA mortgage loan or you are considering a high-risk borrower. So if you currently pay PMI, have at least 20% equity, and your current lender will not remove the PMI, you may consider refinancing. So in other words, if your equity is at the 20%, you might say, hey, lender, can I drop the PMI at this point in time? Because, you should feel comfortable. If they say no, and you can't do that, then you might want to consider, of course, the refinancing option in order to get it removed by basically setting up new loan terms. So then the other thing you might consider is the return on investment. So if we had a scenario like this, we'll work this in Excel, but here's just an example of it. So let's say we had a loan of the $120,000 to start. We're not doing anything down. We're just kind of like looking at the loan itself at this point. So ignore the top part. We had the $120,000 loan, 30-year, 360 months. The rate was at 7%, payment at the 798.36. Let's say 15 years have passed. Then if we looked at the amortization table, or if we were to recalculate the ending loan balance at that point in time, we would have a balance of 88,823. So let's say we want to refinance the loan balance at that point for the remainder of the loan, which would be the second 15 years. Why? Because we're saying the rate went down. So the rate went down by that 1%. So we're going to say, here's my loan balance at this point in time. I would like to refinance for the remainder of the life, 15 years, 180 payments, which would be 15 times 12 at that new rate of the 6%. But in order to do so, I had to put down the $2,500 up front in order to pay for the closing costs to do that. That's going to give me a payment amount of the $749.54, which is a lower monthly payment. So that is good. I can take the difference in those payments, which I believe is going to be the 49 about. I could divide that into the fees, determine basically the break-even point, the way we talked about. I can also kind of try to figure out what the effective rate would be. And we've seen that calculation in prior practice problems. We'll do this in the practice problem, but try to roll in these fees, in essence, to the rate to give me kind of an effective rate, which I could see is still lower than the 7% over here. We can also consider it in terms of, well, really, what am I doing here? I'm investing $2,500 into the home, paying off the loan. So the question could be, if I have the $2,500 up front, then should I put it in refinance, or should I put it somewhere else? So basically, what's my return if I was to refinance? So to calculate your rate of return, you could use the rate function to do that. I won't go into it in detail here, but we get to the 22.62. You can also consider it in terms of a cash flow basis, meaning you put in the $2,500 up front. That's how much you're investing, in essence, in order to save, in essence, kind of have like a cash inflow of the difference in the payments, which would be this minus this, or around 49. It's rounded here for the next 15 years or 180 months. And then you could figure the rate at which that cash flow would be zero, once again 22.62, to consider your rate of return, to then compare that to what you can put your money in elsewhere and see what the rate of return might be if you were to use that money for other options as well. So once again, referencing Investopedia, place you can go for definitions, terminology that are investment related.